Hello students, now we shall look at the rate of return. Okay, how much returns I am getting in terms, this rate of return is in terms of interest, like percentage of interest what returns I am getting. So again this is under module 4 of management and economics, that is 18 ME 51. So the rate of return technique is one of the methods used in selecting an alternative for a project. In this method, the interest rate per interest period is determined, which equates the equivalent worth, either present worth, future worth or annual worth of cash outflows, that is cost or expenditures, to that of cash inflows, that is incomes or revenues of an alternative. So basically what happens in any project, we want to make investment, there will be income, that is revenues, and there will be expenditure, that is outflows. Okay. So this rate of return method, it is finding out the interest rate for the interest period, and which equates how it is done. It equates the equivalent worth, whether it is present worth, future worth or annual worth of the cash outflows to that of the cash inflows. So three types of return appear frequently in engineering economic studies. One is minimum acceptable rate of return, MARR, minimum acceptable rate of return. So it is a rate set by the organization to designate the lowest level of return that makes an investment acceptable. Suppose you want to invest some money, industry wants to invest, say they expect some 12% returns. So minimum, that is known as MAR, that is minimum acceptable rate of return. And there is a concept called IRR, internal rate of return. It is a rate on the unrecovered balance of the investment in a situation where the terminal balance is 0. So this is very popular actually. IRR, internal rate of return, is very popular because here they take the terminal balance is 0, and here it is a discount rate at which NPV stands for net present value, is 0. So what is the rate of return I am getting when the NPV is 0 and the terminal balance is 0? We will see this in our next slides. And then the third one is external rate of return. It is a rate of return that is possible to obtain an investment under the current economic conditions. Okay. So minimum acceptable rate of return is also known as the minimum attractive rate of return, is a lower limit for investment acceptability set by organizations or individuals, because the resources are very limited like money. So we want to use it judiciously and we should get certain, like I said, 12%. So if I get that much, then only I am going to invest in the proposal, otherwise I am not going to invest in the project or proposal. So this is a minimal acceptable rate of return. Now the internal rate of return is the best known and most widely used rate of return methods. It is also known as the true rate of return method and the discounted cash flow method. This is also known as the discounted cash flow method. The internal rate of return, represented by I in the traditional interpretation of interest rates, is the rate of interest earned by an alternative investment on the unrecovered balance of an investment. The internal rate of return can be calculated by equating the annual, present or future worth of cash flows to 0 and solving for the interest rate that allows the equality. So here in the IRR, internal rate of return, the present worth, whether it is annual worth, present worth or future worth, we will consider it as 0, and then we will solve for get the rate of interest what I am going to get. It should be added that solving for the interest rate in this manner results in a polynomial equation, that is a function of I, which may result in multiple roots of the equation. In such cases, the IRR may or may not be one of the equation roots. Although both the EAW, the equivalent annual worth, and future worth approaches are legitimate, the rate of return is often defined in terms of present worth under the constraints of possible I roots, where the IRR is, see, you can calculate the IRR based on EAW as well as FW, but most probably it is used with present worth method only. Okay, where I is the interest rate at which the present worth of the cash flow of the project is 0, or to restate in another way, the rate at which when employed in computing the present worth of all costs and present worth of all returns will make them equal. So here when we consider this present worth for finding out the IRR, internal rate of return, so that IRR is the interest rate at which the present worth of all the cash flows of a project is 0. Okay, or you can in other words, when the rate at which when employed in computing the present worth of all costs and present worth of all returns will make them equal. Because rate of return computations usually begin with a problem expressed in terms of present worth or annual worth, it is necessary to pay attention to the guidelines of EAW and PW methods. So this is a very good method. See, in briefly I'll tell you one thing. Suppose again we will take a proposal of you say a taxi only. You are buying a taxi for 5 lakh rupees. So there are some costs and you can find out the present worth. There are 2-3 proposals. So one taxi may cost you 5 lakhs, luxury sedan may cost you 10 lakhs. Okay, then ekdam saloon, super saloon, that may cost you some 25 lakhs, or SUV may cost some 25 lakhs. So now what is how we are going to calculate compare the 3 proposals? So we will see that we will find out the present worth. Okay, and as it discussed here, the present worth is the most suitable method of finding out. And in the present worth, we are finding that the net present value NPV is 0. Okay, we will make the NPV, net present value of the project, at 0, and then we will find out the value of I. We are going to find out the value of I. IRR is nothing but it is the interest rate. Okay, so we will go to find out the value of I when the NPV is 0. So suppose 5 lakhs taxi you are getting the IRR as 18%. 10 lakhs ka sedan taxi you are getting the interest rate as 16%. And if you take a SUV, the IRR you are getting as 14%. So the best is 5 lakh rupees, which is giving a IRR of 18%. So you will always consider that proposal which has the highest internal rate of return. And this process is also known as discounted cash flow technique and is used to find out the maximum interest rate which you can attain for the proposal. Thank you.